I want to start today's video by sharing an experience I recently had with a client. This is a client who has been working with our company for a couple years now. He is a grandfather, and why I mention that is when he first started working with us, he had purchased a policy for each of his two grandchildren who are both minors. They're under the age of 20. Now, his plan was to set up a whole life insurance policy for his two grandchildren where he moved a lump sum of money he had into a policy for them, and his goal was to make 2 payments and then nothing else after that. Specifically, he had $25,000 that he wanted to move into each of the policies, and if we take one grandchild, his goal was to move that $25,000 into the policy at $12,500 per year, years 1 and 2. So he could do that. We illustrated exactly that. However, the product that he decided to move forward with is called a Whole Life 95 product. And what that means, that Whole Life 95, is that the premium is payable up until age 95. So if one of his grandchildren are 20 years old when they're first starting a policy, they're a little bit younger than that, but let's assume they were 20, and the premiums are payable up until age 95, how long are premiums due in that policy? 75 years, because the policy started for the grandchild at age 20, and then he is not age 95 for another 75 years. So here's what happened. The grandfather started these policies, moved his 2 payments into the policy, and then he saw on his online portal that his contract was referred to as a Whole Life 95 policy. As he went on to read further, he saw that premiums were due for another 75 years plus. He immediately started to panic, thinking, I bought a policy and I was told that I only had to pay into it for 2 years. Now I'm seeing statements and notices from the insurance company that I have to pay premiums forever or my grandchildren have to continue to make payments. This is not what I signed up for. Let's pause there. Put yourself in the client's position. How would you feel in that situation? I can tell you how I would feel. I would feel like the agent deceived me or ripped me off. If you're in the business, your mindset may be, well, was everything disclosed? Did the client perhaps forget something? Because there's a lot of moving pieces with a life insurance policy. The thing is, the individual did purchase a policy that is called a Whole Life 95 policy, which means the premiums are due up until age 95. However, his original plan of making 2 payments and then stopping altogether can easily be accomplished. In fact, that's something that a lot of people we work with do, where they'll take a policy out where they have a lump sum of money. They want to move that lump sum of money into a whole life insurance policy and then never be obligated to make future payments. So today, we're going to discuss exactly how to do that. If you have a whole life insurance policy and you're trying to figure out what to look for, what questions to ask to ensure you can truly stop payments, if you want to stop funding your policy early, what options are available? Let's get on into it. So on the left, we see 4 examples of different whole life insurance policies. We see a whole life or life L95 policy. What this means, this life 95, is that premiums are due up until age 95. In fact, we can take a look at an illustration here. Just to page 2, what do we see here? Whole Life 95, 2021 series, and a look at the last bullet point. Level guarantee premium payable to age 95. So if you have this policy and you look in your formal contract, if you look on your online portal with the insurance company, you will see that premiums are payable up until age 95. If we look at the other examples, a Life 100, sometimes this is referred to as a Whole Life 100. Guess what that means? Premiums are due up until the age of 100. This is the most common type of whole life insurance policy sold in the industry. That sometimes we'll see it referred to as a L121, which means premiums are due up until 121 years of age. Then we see a 15-pay policy or a 10-pay policy. These products don't have an age associated with them. How they work is if we take a 10-pay policy, for example, what that means is that premiums are payable for 10 years. So up here, we see premiums payable until. If I just take out a basic old school whole life insurance policy, I say I want $1 million in life insurance, quote me the premium, and I will pay that for my whole life because it's a whole life insurance product. My whole life, or I should say that the premium payment period is based on those contract terms. So with an L95 policy, let's take a look at this guy, that would be up until age 95. With that particular contract, the last payment is at age 94 because payments are due up until 95. So when I turn 95, I don't have to make payments. Now, if you're watching this video, you might have the thought of, who the heck wants to make premium payments until they're 95? A good friend of mine, somebody told him that once. He goes, I don't care about that age, I'll be dead. I remember that day distinctly. I was early in my career in the business. Here's the thing to be aware of. While premiums are payable up until age 95, you can very, very easily stop funding a policy early. So in our contract language, if I take out a whole life 95, I will see premiums payable until 95. The same would be true of any of these types of contracts. At 15 pay, premiums would be payable for 15 years, whole life 100, up until the age of 100. You would see the same thing on your online portal. But if you do not want to fund the policy that long, whether you make the decision to do so before even starting a policy, as we mentioned earlier, a lot of people with lump sums of cash will deliberately approach a policy with zero intention of continuously making premium payments. Or if you find out after the fact that you cannot continue to make premium payments, or you just don't want to, are you forced to continue to make those payments? The answer is no, not at all. So we've got some action items here, which typically the agent needs to be aware of and help the client exercise this. So if you're working with an agent, they can help you with this. If you're working with us, we can absolutely do this. We may have even educated you on it prior to starting your policy. But 3 main items to be aware of. 1, we've got what is referred to as a premium offset. And what this does is elect for the dividends and interest. When I say dividends and interest, I'm referring to the dividend portion and also the guaranteed portion of a whole life insurance product to pay the premium for us. So what happens is the growth I see within a policy can be used to support my premium, and then everything left over will come back into cash value. But why it is referred to as a premium offset is I am offsetting the need for me to make premium payments with my own cash and having the policy fund itself internally. I do need to have built up cash value to be able to do this. Number 2, an APL, which represents automatic premium loan. What this does is elect for the policy to pay for itself through a loan. This is a great option if someone says, my premium is due right now, I want to pay it, but right now I just don't have the cash. This is very common with real estate investors. I thought I was going to sell a piece of property by March, my premium is due in March, the deal just got delayed, and I'm realistically going to sell it in June. Well, what I can do, if I've got cash value in the policy, I can elect for the cash value to pay the premium through a loan, and then I can pay that loan off later, and the policy will function similar to what it would have functioned as if I made the premium in the first place. In many ways, I'm financing my premium. What I need to be aware of is the loan interest, as that is a cost that goes to the insurance company. And then number 3, a fantastic option to be aware of, RPU, which represents reduced paid up, and this eliminates the premium. Now, this is one of those options that once we exercise this, there's no turning back. So when we exercise a reduced paid up option, we can no longer make premium payments. Even if I want to make payments, I can't. I can borrow and repay all day long, but I can no longer add more money to the product. Now, another item to be aware of with respect to the reduced paid up option is the earliest we can often exercise it is the 8th policy year. And the reason why is this option will lower the death benefit. Because if I have a policy that I can make payments up until age 95, but then after 7 years, I elect to stop the premium altogether and exercise a reduced paid up, the insurance company is going to look at how much I have in cash value and see exactly how much life insurance that purchases me as a fully paid up policy. And the term fully paid up policy represents a policy that is paid up. There's no more premiums due. There's pros and cons to this. I am a fan of it for individuals that are funding a policy with a lump sum because I can eliminate the premium early. It's a fantastic way to maximize the internal rate of return. It's also a fantastic way to maximize the guaranteed cash value. Another item to be aware of is if we drop the death benefit prior to the 8th year, during the first 7 years, what will happen is we'll run into a MEC, a modified endowment contract. So when it comes to the reduced paid up option, it's a great option to eliminate the premium altogether, and it can enhance the policy performance. But while I might not want to make a premium payment in year 3, I ask the question, can I just exercise this reduced paid up in year 3? The answer is no. What I would have to do is exercise a premium offset through policy year 7, and then at the 8th year, I would exercise a reduced paid up, and that would allow me to prevent a modified endowment contract from occurring. So a lot of this is agent terminology, but if we're working with an agent that perhaps is not that experienced in this area, as far as stopping funding altogether with a whole life insurance policy, these are great terms to be aware of just to ask our agent the question. Or if we say, hey, I can't fund it anymore because life happened, what's going to happen with my policy? We typically have these options available. We do need cash value in these options, especially for the first and second one, usually the third one as well. And one other thing before we progress on is all of these options, before exercising them, we can see the exact impact that they will have on our policy. And how we do that is by running an in-force illustration. This is an illustration based on our current values as of today, or at least the policy year we are in right now. So this can be run by the agent, agency, or insurance company that you're working with. And what we like to do for everyone we work with is before implementing any of these changes is first show exactly what it will look like. Here's what it looks like if we make this change. Here's what it looks like if we continue to pay the premium. And here's the other alternative we discussed, if there was another alternative. But seeing it beforehand is very, very important. I like to discuss it as well, just because we don't want to exercise something on our policy where we might think that it's the best option for someone we're working with, but then the policyholder says, no, I don't want to do that. So if we have that awareness up front, we can make an informed decision. So main point here is, while we might see that payments are due forever, do we have to make payments forever? The answer is no. We can easily stop with these different options. And we're going to look at different options. We're going to look at 2 specific case studies where one has a lump sum of money and wants to fund for a very short period of time. So we'll see what the insurance company will continue to do in terms of billing them after the individual adds that lump sum. And then things the agent can do, us in this particular case, to prevent that bill from constantly going to the client and making sure the policy actually performs from a transactional standpoint how we want it to perform. Meaning I don't want to tell this individual, yeah, you can fund the policy for 2 years, and then year 3 he gets a bill, calls me up and says, hey, you said I didn't have to pay. Well, the answer is yes, you do not have to pay, and we can make that change. We just want the awareness up front, mainly so we don't have unnecessary stress. And it's our money. This is very important here. So I hope this video was helpful. We're going to have a lot of fun with the next 2 case studies. If you enjoyed this video, please hit the like button, subscribe for more, and we'll talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.